Welcome back to Investing Talk Podcast. We are focusing today on, well, one of those critical and frankly pretty expensive battlegrounds in the future of transportation. That's the race for autonomous vehicle sensing. Specifically, we're zeroing in on Innoviz technologies. Our mission today is pretty straightforward. We've pulled together the latest technical signals, partnership news, fundamental data, really trying to answer that core question for you. Based on what we're seeing right now, is this key LiDAR stock, a compelling opportunity? Is it time to buy?
Yeah, and this is crucial because Innoviz, well, they're essentially developing the eyes for tomorrow's cars. LiDAR, that's light detection and ranging, it's this high-res sensor tech that makes advanced driver assistance systems, ADS, possible, and eventually full autonomy. Innoviz is right there, positioned as an early leader. So, their valuation is really a bet on how fast this whole mobility revolution happens.
Exactly. And hey, if you want us to look into a specific company in a future analysis like this, just drop us a comment below. And while you're there, please hit that subscribe and like button. It really helps us out, and you won't miss our next discussion. Okay, let's unpack this. The LiDAR space, it feels crowded, right? It seems like everyone's got a sensor solution. So what exactly gives Innoviz its edge? What's their competitive moat, as they say?
Right, the moat. It's less about just having cool tech, though theirs is strong, and more about the massive barrier the auto industry itself creates. Think about getting something like FDA approval for a medical device. Automotive-grade LiDAR isn't, some off-the-shelf thing you just stick in a car.
So you can't just invent a great sensor and start selling it tomorrow.
Precisely. It takes years. Years of really tough, expensive testing and qualification. Car makers need both it's reliable, durable, safe, in all kinds of weather. It's intense because Innoviz has actually gone through that whole painful process, that multi-year gauntlet, and won key contracts. Well, that makes them an early leader, that qualification hurdle. It's almost impossible for new players to just jump over and catch up quickly. They're already on the path to mass production.
And the sources we looked at really stress it's not just the physical sensor, it's the whole package deal.
Exactly right. Their edge comes from their own hardware, the InnoviZone, the newer Innoviz 2 sensors, plus the perception software that actually makes sense of all that data. It's that complete solution that meets those super tough auto standards. And that's what gets you that long-term, sticky customer relationship.
And that loyalty, I guess the prime example is the big BMW deal, right? That anchors their long-term view.
Yeah.
But it sounds like they're getting traction beyond just BMW now, which must help validate the tech.
It is. Yeah, one of the really promising recent things was this announcement, a statement of development work, an SOW, with a top 5 global passenger car maker. Now, for you listening, an SOW in the auto world, that's significant. It's not just kicking the tires. It means a deep commitment, moving past just looking towards actually developing a contract. It's like going from dating to being engaged, It really legitimizes their growth story beyond that initial big win.
Okay, securing those huge auto contracts is critical, obviously. But waiting for the big revenue from mass production, that takes years. Are they doing anything else to bring in revenue sooner when they wait?
They are, yeah. Smart move. They launched something called Innoviz Smart. It targets industrial uses, things outside of passenger cars, think drones, security, logistics. This diversification helps broaden their market long term, makes them less dependent on just the ups and downs of the auto industry. Shows good strategic thinking. So, okay, connecting this all together, the tech looks solid. They've got these important commitments. But for investors, the question always comes back to money, right? If they've built this tech fortress, do they have enough cash inside to, survive the wait? What do the financials actually tell us about their path from startup to hopefully profitability?
Right. The money story shows that classic high growth picture. Revenue climbing fast, but yeah, still burning cash. But crucially, the burn rate is improving significantly. Let's look at 2024. Revenue hit $24.27 million. That's up 16.25% from 2023. Respectable growth.
And the key thing, the losses are shrinking and shrinking fast. They cut their net loss by over 23% compared to 2023, down to about $94.76 million. That trend, revenue going up, losses coming down, that's exactly what growth investors look for in this phase. Plus, we saw Q2 2025 revenues hit $9.75 million. That's a big jump year over year, shows that acceleration is continuing.
Okay, but with all that spending on R&D to stay ahead, does the balance sheet actually support this ramp up? Or should we worry they'll need more cash soon?
Good question. Right now, the balance sheet looks pretty solid, actually. They've got a decent cash balance, not much debt. That suggests good flexibility. Now, yes, free cash flow is still negative. That's totally normal for this kind of capital-heavy phase. Building factories, R&D, it costs money up front. But, and this is key, it's expected to improve a lot. Why? Because those big OEM contracts like BMW, they're moving out of the low revenue development stage and into the high revenue mass production phase. That's the inflection point. That's where revenue growth really starts to outrun the operating costs.
So based on that expected ramp, what are analysts forecasting near term?
Well, the consensus forecast is for continued acceleration. The company itself guided for full year 2025 revenue between $50 and $60 million. That's a huge jump, shows a lot of confidence internally and externally in their production ramp and their ability to execute right now.
Okay, this is where it gets really interesting for me. Because the technical chart seems to be telling the same story as the fundamentals are starting to suggest.
Yeah.
The sources show a remarkably bullish technical setup just over the last 3 months. But hang on. If the fundamentals still show negative cash flow and big operating losses, why are the technicals getting so much attention? Shouldn't the balance sheet reality matter more right now?
That's a really important point to raise. It's a fair critique. But often, technical momentum like this signals that the market, the smart money, believes that inflection point we talked about. They believe it's coming soon, very soon. We've seen a real change in the stock's behavior. It moved cleanly up from that $1.30 to $1.50 range. Now it's trading above $2. It's making that classic bullish pattern. Higher lows, higher highs. Closed at $2.18 just recently, October 13th.
And it's not just a random spike, right? The moving averages confirm the trend.
Exactly. That's the confirmation. Back on September 8th, the 10-day moving average crossed clearly above the 50-day. That crossover, it signals that the recent buying pressure has really taken control from the medium-term trend. It's a shift in psychology. And the fact that the price is comfortably above both the 50-day, which is around $1.81, and the 200-day at $1.31, well, that paints a very strong technical picture overall.
So that breakout above $2, that might have been the signal some bigger players were waiting for.
I think absolutely. Institutional money often needs that kind of technical confirmation, that break above a key level like $2 before they commit serious capital. We saw firms like Capital Advisors, for instance, start a new position just this month, October 2025. It suggests institutions are getting more confident that this inflection point is real, and they see $2 as that critical breakout zone.
And this technical strength, it seems like the analyst community is seeing it too. What's the consensus on price targets?
Sentiment is definitely strong there. You've got a strong buy consensus rating with 3 or 4 analysts covering it with that rating. The average 12-month price target sitting around $3.27. That implies, potential upside of maybe 50% to 57% from where it is now. You see specific targets too, like Westpark Capital at $3.30. That's a pretty significant return expectation baked in.
Wait a second, though. We have to tackle this conflicting signal. The sources mentioned strong institutional buying, multiple strong buys. But then Weiss Ratings slapped a sell D rating on it again in late September. That's a really negative rating. What are they seeing that these big buyers and other analysts are just ignoring?
Yeah, that's the inherent tension here, isn't it? The Weiss rating is almost certainly focused squarely on the current financial state, specifically that high cash burn rate and the fact that free cash flow is still deep in the red. They're prioritizing today's profitability or lack thereof over the future potential and the market momentum. It's sort of a classic disagreement, value perspective versus growth perspective. For us looking at this, it's a necessary reminder. It tells you the risk profile is still high, even with the bullish chart. It's not a sure thing yet. So this really leads to the next important question. Given this technical breakout and this potential inflection point everyone's talking about, what specific events, what catalyst could actually push the stock past that, say, $3 resistance level in the new term, like next 0 to 3 months?
Yeah, the calendar looks pretty packed, actually. The absolute most crucial one coming up is the Q3 2025 earnings report. That's set for November 13th. If they hit their numbers or you beat them, showing that revenue acceleration year over year, showing those losses narrowing again, that basically validates the whole bullish story. It could be a major inflection point for the price, a big move upward.
And then there are those market mechanics, things that can add buying pressure just by themselves.
Exactly, like index rebalancing.
Yeah.
There's a key ETF rebalancing scheduled for December 20th. That can often force funds to buy shares of component stocks like this, adding liquidity and maybe boosting the price. But maybe the biggest X factor, the wild card, is all the speculative buzz, the rumors. They just keep swirling. Potential new strategic partnerships, maybe another top global automaker, or even takeover talk, acquisition by a bigger player. If any of those rumors turn into real news, you're talking serious potential upside practically overnight.
Absolutely. But, investing in high growth tech always comes with significant risks. We have to be really clear about the potential downsides too.
For sure. The number one risk is still that cash burn and the absolute need for perfect execution. They have to keep pouring money into R&D to stay ahead technologically.
Yeah.
If those operating losses don't shrink exactly as projected, or, if the overall capital markets get tight and raising money becomes harder, funding could become a real issue.
Then there's customer concentration. It's great having BMW and this other top 5 OEM, but in the short term, yeah, their revenue might depend really heavily on just those two huge customers. Any delay, any hiccup with either of those big programs could hit the company's results hard and fast. It's an outsized risk.
And the last big one, the structural risk, adoption delays. What if the mass adoption of ADAs, of autonomous driving features, just slows down? Maybe regulations take longer, maybe consumers are wary. That would push back the timeline for Innoviz to actually start generating positive cash flow, putting more pressure on that financial runway we talked about. So, okay, let's bring it all together. The source material we reviewed, it paints a pretty compelling picture, doesn't it? A company that seems to be successfully shifting from just being a tech leader to actually scaling up commercially. So we land with a strong overall bullish rating here, driven by that commercial ramp-up, their defendable IP, that tech moat, and importantly, that confirmed technical momentum we're seeing right now on the charts.
It really does seem attractive at this moment, both for maybe shorter-term traders looking at those upcoming catalysts like earnings,
Yeah.
but maybe more importantly for long-term investors who want exposure to the whole autonomous vehicle revolution, this structural growth story. The way the stock is acting now suggests the market is starting to believe in their success, starting to price it in.
What's fascinating here, thinking bigger picture, is we're right on the edge of a huge structural shift. Not just tech, but regulation too. Governments, safety trends, they're all pushing for cars with more driver assistance, higher ADOs content. That means more demand for LiDAR. So here's the final thought for you to consider. If this underlying trend, this move towards higher ADOs content, actually accelerates faster than analysts are currently modeling, what does that immediate shift imply for Innoviz's valuation right now, even before we see that crucial November earnings report? That's the question to mull over this week.
That's an excellent thought experiment to end on. Thanks for joining us for this discussion.
We'll see you next time on Investing Talk Podcast.